Okay, we'll get started here in just a few minutes, folks. All right, well, welcome to this week's stock market review. My name is Bennett McDowell with traderscoach.com. Great to have you here. All right, if you experience any audio or visual problems during the presentation today, let us know in the comments area. These speakers are usually the last one to know there's a problem, so keep that in mind. We're going to be with you for about a half an hour today. We're going to cover we're going to analyze the major indexes using our software and technical analysis. And then we're also going to talk a little bit about the housing market and also about interest rates as well. Big day today on the interest rate front. All right, before we get going, for those of you who are here, go ahead and just type in what you think is going to happen with the interest rates. Are they going to remain flat? Do you think they're going to go up, down? Let me know what you think, and then we'll go over some of the Fed Watch information and so forth. All right, so let me get going here. I guess what I'll do is I'll go full screen here, and then we'll go ahead and knock out some of these administrational items I got to go through, which include, of course, please give us a like. Take a minute just to, if you won't mind right now, and do that for us real quick. That helps the channel. So I'll give you a second to just do that. And also, too, we have to talk about the risks involved in trading. Like I always say, without risk in trading, there is no opportunity. So the two really go hand in hand. The key thing with trading, whether you're a day trader or a position trader, is obviously you have to have an edge, right? And that's easier said than done, but that's step one. And then with that edge, you have to use really, really strict risk control. And that's really a vital part of being successful in this business. You can have a great system, but if you don't have your risk control down pat, then your losers can get away from you. So you got to be really careful about that. It sounds easy. It's very difficult. We've helped traders literally around the world for the last, 30 years now, do this type of thing. So we know what's important, and that is extremely important. The other thing that is important is always please fund your account with money you can afford to risk. And if you can't risk any, do it in a simulated environment until you're successful. Now, I put a link up already, but I don't know if you can see it if you're new or just came in, but I'm going to put it up again. Let me just put the banner up real quick as well. And there's a reason I'm doing this here, because what I want to emphasize here is that there's a company called Apex. It's a prop funding account, but also too, it's a really great way for you to get involved in, if you're into day trading, involved in day trading without really risking your own money. And so therefore, these accounts, basically, you have to have a little bit of a track record, obviously, before they're going to actually turn your evaluation account into what they call a funded account. And then you can actually earn money with that. but you do have to have an edge. You do have to have good risk control, but this is not a bad place to begin. Now, the other big part about this that's so good is the fact that they give you data as well. So during the evaluation period, you don't have to pay for data at all, okay? So they give you free futures data. So that's just something to keep in mind. And I just wanted to put that up there and put a link in there for you to get a discount on their services using our link and coupon code. So that's all I'm going to say about it. All right. So I'm going to hide that for now. And the other thing with risk control is that if we look at some stocks or anything I may recommend today, please run that by your financial advisor or whoever manages your money, just to be sure what we talk about here is suitable for you, okay? We don't know your personal situation. They do. So risk control, really important stuff, and I certainly want to make sure you're aware of that. I've got a couple books on risk control. That's how important I think it is, all right, out there. And so those are available. I'll put a link in the recording down below, or you can just go to our website under education and then choose books, and it will take you right to our Amazon book page. But we've got books on money management, risk control, how to implement that in your trading, whether you're a day trader, position trader, futures, stocks, forex, doesn't matter. All right, and then I've got Elliott Wave Techniques published by McGraw-Hill. That is a book on the Elliott Wave, survival guide for traders on how to run your trading business right out of your house like a professional hedge fund. And then The Art of Trading, brand new book, second edition on the far right, coming out later this year. It's done. So it's just a matter of getting it released, but you can pre-order this at a really good price. And again, I'll put the link below, but that's going to be a really nice book. It's about 450, 500 pages, depending on how they're going to lay it out. So it's a pretty comprehensive book on trading the financial markets. So definitely check that out. All right. So we start out today, Wednesday. Let me just see if I can enlarge this so we can all see it a little better. How's that? All right. So let's see what we got cooking here. So we got today, what's the big thing for today, folks? What is the big thing for today? FOMC, right? All right, so they got their meeting coming out at 2 o'clock. And equally as important is the meeting afterwards, by the Fed Chair Chairman Powell, of course, at 2:30 p.m. So these are all Eastern time. So 2 p.m. we've got FOMC, and then 2:30 we got Powell speaking. And basically the market's going to listen to what he says very closely today. So again, if you're day trading, you might want to, there'll be a lot of volatility around that announcement. So definitely be careful about that. If you can get on the right side of it, then there you go, right? All right, so my consensus on this is that rates are going to stay flat, okay? Now, I'm going to, later in the situation, we'll talk a little bit more about interest rates, but that seems to be where the Fed watch is. It's almost a certainty for that matter. All right, now we got NBA mortgage apps, which come out every Wednesday at 7. Mortgages ain't doing too good, folks. Lowest levels they've been in like a decade or so, if not more. So not so good there. CPI out today at 8:30. EIA petroleum status report as well. So big day today on the announcements. All right, Thursday, tomorrow, which tends to be, Thursday usually is the busiest day of the week, but not necessarily the most important day of the week in terms of economic announcements. And we've got jobless claims coming out, PPI coming out, EIA natural gas report, Fed balance sheet. All right, Friday, we end the week, June 14th, already halfway through the month. Can you believe it? And then you got June 21st, and that'll be the longest day of the year, and then it starts reversing back again. Unbelievable. All right, import and export prices, 8:30 a.m. Consumer sentiment, 10 a.m. And the usual weekly Baker Hughes rig count and some speakers, okay? So keep an eye on the Fed today, all right, for sure. That's going to be a big one. A little bit more on the rate decision. Let's see what we got here. The Federal Reserve is expected to announce an interest rate at 2 p.m. We know that. The market will look for clues in Powell's remarks. We know that. And also, too, I think what people are going to be watching very closely is what's going to happen for the rest of the year. Now, beginning of the year, they talked about 6 rate cuts, right? All right. And I kind of came out fairly early and said, we'll be lucky if we get 2. We still could get 2. All right. It's an election year. I think we'll probably get 1 maybe in September. That's possible. All right. And that would be before the election. We're going to have to see how the economy and how the market's doing, however. I anticipate if the market starts to get a little choppy and we start to heading towards a slowdown, we could see a rate decrease in order to keep things as stable as possible. All right. Yeah, so there it goes. And Bradley, I agree with you. I think Bradley's also stating that he thinks rates will stay flat. I agree with you on that. Okay. So that's kind of, I think, where we're at on that. All right. If anybody else has any comments, feel free to put them up there. All right. When we look at charts, we're going to be using software here at traderscoach.com. We have a whole website also called appliedrealitytrading.com that deals with the software. We offer trials on the software, so you might want to check that out. I'll put some links at the bottom in the recording for that, or you can go to our website. But we have, software that can be used for day trading, position trading. We have scanners, and of course, the all-important risk control aspect. So we cover that as well. All right. Let me just read this little thing. I pull these things off the internet, so I kind of like to share them with you. So this is the May CPI report feeds rate cut optimism, which is kind of interesting. So they came out with this, and basically this kind of, and this kit was on briefing.com. Okay, this was today, actually. So this was kind of interesting. And I guess what I want to share with you, give me a second if I can find it. And basically they said they kind of think that we may see 2 rate cuts before the end of the year based on this, which I kind of find interesting. All right. So here's what they say. That thinking has manifested itself in the Fed funds future market. According to the CME FedWatch tool, the probability of a 25 basis point reduction in the target range for the Fed rate at the September, not the June, September FOMC meeting has increased now to 71% from just 54% prior to today's release. In turn, the probability of a second rate cut at the December FOMC meeting has increased to 70% from 52.4% just prior. I think we're a little optimistic on this report. Things change week to week on those percentages, but that's kind of what they're saying for today. All right, now that leads me into the current chart for this week. And this is the Dow Jones Industrial Average, and we're watching it like a hawk. So basically here, and I'm going to show you the S&P and the NASDAQ. So for those of you that like to follow those, we will get to that as well. All right. So what I want to point out here is that, back here, we had a really significant bottom here. And this goes back to October 2022. And honestly, if you watch this trend line being drawn here, it's a long-term trend line. And then we have some short-term trend lines as well up here. And that's being drawn by our Trendline Master software. So it's an automatic trend drawing system. And that's part of our software tools. So the idea is then we use Elliott Wave, and there are 5 waves in a trend before the trend ends. And how do we know where that trend ends? Well, then we use Fibonacci extensions. So, when we give you a target zone like up here, it's based off a fairly structured procedure of Elliott Wave, Fib extensions, and multiple time frame analysis. All right. So all that stuff goes into this type of formulation of where we think these targets are going to be. So the target for the Dow was around 40,238 up to 47,360. So this is where we think that 5th wave will end, in between or in this green box. Okay. And it could end anywhere in there. Now, we can get a little more precise if we go to the 60-minute chart. I'll show you that in a minute. But the key is that it didn't quite hit it yet. But boy, did we come close. Look at that. All right. So that can't be totally discounted. 15% of the time, markets do not go into that on the fifth wave. 70% of the time they do. And then 15% of the time they even go a little higher. So the high probability zone is in that green boxed area. But there is a possibility that we have gotten close enough for a top in the market. So we're going to keep an eye on that. Now, a couple things here. All right, we've got a support level down here we're watching, and that's at 37,611.55. Now, the markets today are around 38,861 and some change. So they're up about 114 points today on the Dow. All right, and it's across the board. All the NASDAQ's up and the S&P is up and the Russell's up. So kind of a bullishness. So we're keeping an eye on that support level. If that gets broken, all right, that's kind of like what I call the shot over the bow. We have to pay attention. But, you know, we could get a pullback anywhere in this region as long as we stay above this major support, which is much lower at 32,327.20. Then anything here could be sideways motion, more of the correction, and it still could rebound and go back into the target zone. Okay, so that's possible. But if it goes below this minor support, then it kind of means we're going to have a messy market for a little while, and it's going to take longer. Now, if it keeps on going or goes sideways and breaks to the downside and goes below this, then the top is in. Okay, then this is one of those 15% of the time that we came very close to the target. Now, we do have a double top here, but also too, that could be part of a channel that's unfolding too. So I kind of feel a little reserved on what I think exactly is going to happen in terms of the market. So we're kind of in a position here where the market has got to tell us what it's going to do instead of me telling it what to do, right? All right, as much as we'd love to see that, okay? But in this case here, we'll wait, all right, and see what it is. I wouldn't be surprised if we get another high, especially if they drop rates in September, okay? So maybe we have a little bit of sideways motion, and as long as no major event or anything occurs between now and September, then we probably will drift for a while, and a lower rate could cause enthusiasm to get it back up in here. Now, if no rates come or there's something that happens in the economy or a world event, and then it could end the move up to the upside. So we're going to watch both of these support levels and see what unfolds as the summer unfolds. But that's kind of where we're at now. Now, personally, talk to your financial advisor about this. I would not be a buyer of stocks, okay, unless I was a short-term trader here. So if you're thinking about adding things to your long-term portfolio and, you're getting close to retirement, there's too much risk, okay? It's too much risk. We're in a bubble in a variety of different markets, including the real estate market and the stock market. Bubbles can go on for quite some time, but when they burst, right? So I think there's a lot of risk in taking on stocks at these levels. I even think Warren Buffett came out and said that, if I'm not mistaken. So you got to be careful here. All right. Now, if you're young and you're dollar cost averaging and you can, you got, 15 years left in the market. Okay. All right. Maybe. But even then, I'd be careful about it. All right. But as traders, too close to the target, guys. All right. So be careful here. So I would not be a buyer here, but I would talk to your financial advisor and kind of talk a little bit about a defensive game plan for you if the market starts breaking through these support levels. Just saying, right? All right. For example, maybe you'll sell some stocks if it comes down below that minor support. Maybe you'll take some inverse ETFs if it goes below the major support, things like that. But anyway, you work that out with your financial advisor, however best you see fit. All right. Now, this is the 60-minute chart, and it's showing that we're going to go down again, even though we're up a little bit today. So we're at 38. So we kind of went a little higher in here. But this retracement zone is a fib retracement, and it's based on the fact that the market will go to these areas and after a big steep down. They retrace to these areas, It's a combination of things that cause that. I won't go into that here. Some short covering, et cetera, et cetera. Okay, but it's part of the Elliott Wave. And so at this particular point, we'll head back down. And this is still bearish right now. That's PTF is indicating more short-term lows. Now, this was as of Sunday. So let's take a look at that today and see what's cooking and see if that either changed or is still red, even though prices have gone up a little bit. All right, so that's the 60-minute chart. The purpose of this chart is it kind of gives you a little bit of an outlook for the next week. So I like to show this to our subscribers on Sunday in the MORE report, which stands for Market Opportunity Report, which is released on Sunday with a video. And I kind of try to use this chart to give people direction of the next week upcoming. So that's the purpose of this chart. All right, now S&P 500 has hit the target and still, again, trending up. So this is kind of interesting. This means that this could end at any time. So far, we have trend lines still on the bullish side. So from a technical standpoint, the uptrend has not ended, even though it's in the target zone. So you could go up to the higher part of this target zone as well. All right. I think that's probably what's going to happen. Now, the NASDAQ has not quite hit its target zone. And I think that's kind of interesting that the S&P hit it and the NASDAQ didn't. But that shows that we still got some more upside on the NASDAQ. And that target, more precisely, is 17,691 to 19,217. And the long-term targets, based on even going further back on the retracement, is indicating 19,387 to 25,129. So long-term, all right, that's probably where we're going. Short-term, we might hit a little resistance up here in a pullback before it heads higher. So in a case like this, if the NASDAQ is going up with the big boys, then chances are that's going to lift the entire market. So I don't think we have a top in on the market, though I think we could have a little bit of sideways motion as we ferret out what's going on this summer. And then maybe with a lower rate in the fall, we start to move up a little more dramatically, that type of thing, okay? On the real estate front, this is always a fun thing. Now, I showed this every week, so this is not new for you people coming, but this is the Case-Shiller versus the CPI. Case-Shiller is in red here, and the CPI is under here in black. And the CPI is the Consumer Price Index, kind of measures inflation, but, it leaves a lot of things out. I don't think energy's out in it and things like that. Food, I don't even think's in it. But in any case, it's a measure of inflation. And if you go back to the 1970s, which we can see way back here, you can see the Case-Shiller Index, which is a measure of the average home prices in the United States. Now, when we talk about real estate, one thing I want to just make perfectly clear, and if you listen to any real estate person out there, they always say that, but it's true. Real estate's local, right? Okay. What I'm discussing here are national averages. So things can be different in your neck of the woods. For example, Texas and Florida are seeing some more severe price declines as compared to California, for example. All right. So it's very local, but this is a national average. So let's see what it's really saying. So as you can see, real estate, if you go back to the 1970s, has maintained a healthy distance from the CPI for the most part, which means that it's a good investment because it beats inflation, right? So for those of us who bought homes because we need a place to live, it's also been a good place to put your money because you got a return on it because it keeps going up and it stays above inflation. But there's times when the Case-Shiller gets too far away from the CPI. And these are what we call bubbles. This was the financial crisis. And basically it went from what, 06 until it started breaking in 08. So it was almost 2 years that it stayed kind of toppy before it break. But look where we are now, all right? And we have been here for a while and still topping here. So, okay, that's quite a bit of distance away from the current CPI, right? So one or two things going to happen. We're going to either have hyperinflation that catches up to real estate, right? Or you're going to have a bust in real estate and it's got to come down to the CPI. So I think we're probably going to pull down in real estate at some point. I don't know exactly when. These bubbles are hard to know when they burst or what causes them. We could go into a recession next year or something like that bursts the stock market and the housing market. Hard to say. All right. But in any case, there we are at a significant distance away from the CPI. And that when I see that type of thing, it flashes up a warning signal. To get back close to the CPI, we have to come down about 40, 50%. That's a lot. All right. So would I be a buyer of real estate here? Well, I would be if I have to have a place to live. All right. Maybe as an investment, no. Okay. But as a place to live, I guess, probably so. Either that or rent if you'd have to, and then wait for it to come down. I'll leave that up to you. Interest rates, yeah, they've gone up. But housing has gone up so much. So you got a 40% increase in housing recently, and if not more. And then you've got interest rates going up. So it's making it very unaffordable for most Americans. And that's also a problem in real estate. So I think you're going to get a burst of the bubble here at some point. All right. Now, Realtor.com releases inventory data for the May 2024 period. And the inventory is growing. Okay. So what happens when inventory usually grows? Prices start to come down a little bit. All right. Buyers have more to choose from in that case. They don't have to be as jumpy as when there's just a few out there, a few homes to choose from, right? So if you have more homes, you can be a little bit more choosy and price conscious on what you actually want to buy. So that actually bodes for inventory increasing. It did not increase, May 2021, it was low because rates were going up and people didn't want to buy homes or even sell them with the higher rates because they were comfortable with their current mortgages at a lower rate. Okay. So it's improving. All right. So it's 35% over the last year. All right. So that is kind of in the right direction for a possible decrease in home prices. All right. This is for California. There's still a shortage. Like I said, real estate's local. This is proof in the pudding. So there's still an inventory shortage in California. Listings need to increase 20 or 30% before prices drop meaningfully. So the inventory is coming up. All right. So if this continues, that will eventually reach a level in California where basically prices will start to head down. Now, I can tell you, just because prices are high does not mean you're having a lot of transactions either. So transactions are much lower than they were before as well. All right. And mortgage applications are in the pits. Not a good time to be a mortgage broker. If anybody is out there a mortgage broker, it's my prayer. I send my prayers to you because it's a tough business right now. Okay. And it will improve with time, but these are the cycles you have to survive during certain times like this. And real estate brokers are feeling it too. All right. There's not a lot of transactions out there. All right. So anyway, that's kind of that. 30-year fixed mortgage as of, this can change a lot, but basically the rate this week was around 7.06. Last week at 7.17, a little bit down. Okay. 15-year was 6.56. The ARM is 6.62 and then 7.16. There's a little concern over the mortgage industry and what is going to happen in terms of the Fed's releasing or making it easier to get the HELOC loans, second mortgages on homes. And they're looking at that because people are struggling, but they have all this equity in their homes. So they're pushing these HELOCs like they did prior to the financial crisis, which could be a little bit of a concern. But people are concerned because credit card debt is so high. Okay, so they're hoping they'll refinance their home, take a lower interest rate, pay off the credit cards. The problem is then now you've got a long-term mortgage you have to deal with. So, no free lunch. You got to figure it out. Okay. All right. So let me just quickly get out of here for a minute. I do want to look at Bitcoin. Bitcoin's kind of coming back up again today, but again, it's kind of been stagnant. We've kind of been running to the sideways here for quite some time, really since, April, March, bingo, and then kind of drifting. But what I'm liking and seeing here is we've got some type of floor being built here. And I like that. If you go back to the weekly chart here, you know, this is the first period where we've had a floor here that could be building a base in this price range from it to spring up. And it looks like, based on our indicators, our software tools, that we are going to go up again. Now, there is a possibility, it's not the higher probability, that we could float back down into this lower target before going back up. Okay, that's a possibility. But this is the target for the next impulsive big move up. And we may be in it, just drifting sideways until we get out of it. So that target for Bitcoin for me is 87,274 up to 106,353. So that is a target that I think is reasonable, probably by the end of the year. Now, if we break out of this red line, which is anchored on this high here. So what I think is we've got a Elliott Wave 3 for you Elliott Wave people, an A, a B high here, and a C. If prices do not break above that B, then we're technically still in a position where we could go into a complex correction, drift sideways, and if it's a complex correction, then something like this could occur, and we could go down to an E wave and then bounce up onto the next wave. So hard to say. We got to break out of this red line, and that's really important. I think that's 72,777. Let me just grab the tools on that. Let me erase that for a second. So that's this high here, 72,777. So I was right. So that's what we're waiting for it to happen. Okay. Now, if it breaks that line, then I think it's going to quickly go into the target. So if it does it, let's say it did it this week, not saying it's going to, but if it did, then that would move, probably march right up there. And by the end of the summer, we'd be in that target. Okay. So we'll see what happens with this. Regardless if we get sideways motion or another slight pullback, regardless, this is a bull market. All right. So this is going to make higher highs. The $1 million question is when. Okay. So I'm not concerned about holding Bitcoin here and even adding into it if it does the unexpected and comes back down again. Okay. So that's kind of my position on Bitcoin. And we'll see what happens, see how that unfolds. All right. So I think that ends. I'm pretty much done here. Now, if you want me to look up any individual stocks, what I can do here is come back on Friday. I have Stock Analysis Friday here that's live and on YouTube, Facebook, and LinkedIn. And I basically usually there about an hour to an hour and 20 minutes with you all. And I'm glad to look up stocks. If your broker calls you and says, hey, buy this, let's look at it together from a technical standpoint. They usually look at it from a story standpoint. You know, a broker, when they call you, is usually going to have a story. All right. You know, they just changed management. This is a really good buy. Everybody's getting into it. They're coming out with a new chip. You know, la. It's always a story. But take a look at it technically and see what the reality of the technicals are telling you. And that's what we do on Fridays. So, you know, if you're in a stock and you want to know where my stop exit should be to get out, what should I do with it? I've been in it for a long time. I got a lot of profit. I don't want to give it back. The market folds over, things like that. Come here and I'll give you some support levels based on our software that I think makes sense for getting out of certain markets. So that's Stock Analysis Friday, and that's every Friday at 8 a.m. So we'll see you there, and it's on YouTube as well. All right, so that's it for this week. We'll see you back here next week, and thanks for coming by, and we'll go ahead and close this room in just a little bit. If you're our current clients, don't forget we have client support in about half an hour. And so I'll see you again there. All right. Have a great week, everybody. I'll put a little music on and we'll see you next week.